Please like and leave a heart, please.
There we go. There we go. Turn on the button, and now we can hear it. So I need to be able to click mute on this one. There we go. Whoop. So now everything, do we have sound? No volume. It should be working. Hopefully now it's working. Man, the camera looks really good today. I guess it's because everything else we have going on here. So yeah, guys, let me know if you can hear me. So yeah, today's show, even though I've got the little thing up here, it says Vidor Locksmith Show. It's not really a Vidor Locksmith Show. It's something new that I'm doing called Gibson Catalyst. And now what we're trying to do is be able to help and encourage and educate others out there across multiple industries, not just the oil and gas industries, but how to be able to invest in the oil and gas industry and understanding the landscape of being able to invest in the oil and gas industry. This is something that I have taken upon myself to be able to teach and learn, mainly due to so much thanks to the guy that works directly across the hall from me, Rick Allen, who's been absolutely amazing. He's been a huge mentor to me, and I owe all the credit to him. So, yeah, just normal stuff that we do here on the live show. Guys, let me know where you're watching from. Give us a comment here in the comment section. Love to be able to say hi to everybody. Like I said, I've got 2 camera systems set up. We're doing a little bit different today. But yeah, I'm really excited about this. This is something completely new. So, like I said, another interesting thing that I definitely need to be able to say before we get started on this: 1, I am not a lawyer. 2, I'm not a CPA. I'm not a professional engineer, fiduciary, or anything like that. So anything that we say here is purely for educational purposes. If need be, consult with all the other professional people in your life. They can give you paid for advice as opposed to listening to somebody on the internet like myself, right? So, trying to think, I had a whole bunch of notes and everything written out, and I left them over at the other desk. But, like I said, Tracy's going to hand it to me. Thank you. Make sure I don't miss anything. Yeah, I'll give my background at the end. So course objectives today. So some of the things that we're going to be going over and we want to be able to learn are the basics of the oil and gas industry, a little bit of an overview. I know that there's a lot of people watching this that are in the oil and gas industry, and that's perfectly fine, but not everybody knows what we know. So we're going to try to go through some of the pure basics there. Look at the chronological events of a oil and gas well. Then we're going to look at some of the investment opportunities and considerations. What is working interest? What are some of the financial aspects? Risk management tools, legal and contractual considerations, and then a bunch of frequently asked questions. And I am one to talk way too much, and so I'm going to try my best to be able to pack as much of this in to an hour as possible. Like I said, if you guys are watching, if you have questions, please feel free to be able to put them out there at any point in time. All right. So what I'm going to try to be able to do here is something fancy, and we're going to use the glow board for once, right? Here goes. All right. So hold tight with me. Make sure that the audio still works on this. I believe you guys could possibly hear me, but that doesn't mean that you guys can see me. So what we're going to do is stage, and just like that, boom, there we go. Hopefully that works. And see, now I've got control over all of this. And so somebody had said better. See, I'm at the correct location for this. So that one's just signed in like you're a guest on the show. This is the one that's actually controlling the show here. So yeah, sound good. Nice to see Randy McDonald's here. Rebecca Cunningham, that's my mom. So everybody If y'all wanted to know, there it is. Kelly Smith tuning in. Thanks for being here. Do appreciate it. Victoria Parker, or sorry, Porter, tuning in from Houston. Shakant, tuning in from Canada. Had a good conversation with him last week. Oh, there. Kelly says he's from Yorktown. It says deep audio, lip reading skill required. Deep audio. All good. Mr. Paul Moore tuning in. All right. Thanks, guys. All right. So we've got a lot of people. We got people watching on YouTube for the first time ever, probably people watching on Facebook, which is good. I think it's also broadcasting to Twitter, Instagram. I don't know if the Instagram one's working. If it is, you guys are going to have to let me know. I have no idea how to do the Instagram part. So we'll have to definitely check with that. All right. So like I said, so today, let's go ahead and get started. So we're going to do a quick overview of the oil and gas industry. I didn't bring up the PowerPoint presentation like I need to. Present slides. Where is it? Your computer? No, it's already open. Oh, no, present. And share screen. Open systems. Yes. Allow me to do this. Nope, that's not the right one. Window. Sorry, guys. This is all. A lot of this is very new here. So share that one. Oh, it's not going to let me do it right now. I'm going to have to restart Chrome and do all this. All right. Well, screw it. I'll just have to. Tracy, if you would you open up the on that one where it says present down at the bottom? Yep. And then open up the PowerPoint presentation from that one.
Slides?
Yeah, do slides. And then the file should be saved in the Gibson Catalyst folder. All right. All right. So since we don't have that up and running right now, and like I said, the audience here for this is definitely a lot of the people that are completely new to the industry. So here we go, and I anticipate a lot of people watching this after the fact. And so, how far into this are we? And I've just been blabbing along. So 8 minutes in. My apology, yes. So I haven't checked to see where all of the coordinates are on this, but we've got three main areas to the oil and gas industry, right? So we've got upstream. Right, and I had this all in my notes so that I didn't have to write it. Midstream, right, and then downstream. I even tried to put this together with a little AI thing and get pictures of each one, but it looked terrible. So let me know if that's looking correct. Do you guys read that correctly? Because the last time we tried to do this cold board, everything was swapped, whatever. So hopefully that looks correct to you guys. If it does, that's a huge success in and of itself that we got that to be able to work. So what is upstream? So when you think of upstream, anytime in the oil and gas industry, upstream is going to be where you actually see the drilling rigs, or you see the little pump jacks, like the little guy that's on my shirt here, right? So that is your upstream sector. So we'll make nice little logos here for it. So something like this, right, where the little pump jack goes up and down, right? That's your upstream side of the business. All right. So your midstream then is going to be, lack of a better way to be able to draw this out, little trucks and stuff and a tube, right? Pipeline, right? That's going to be your midstream sector, right? And that's the midstream portion of the business, is taking the oil and gas and hydrocarbons that we able to harvest from the rig sites or where the wellhead is, and then putting them into either a truck or into a pipeline to be able to go off to what would be the downstream portion of the business. And so then the downstream, to be able to draw a picture of this, it's just going to be a bunch of little pipes and stuff that go everywhere, right? This is, I don't know if any of you have ever been in the South Houston area. This is where everything is broken down and put into different, I can't even draw anything that represents that very well, so I'm just going to erase it. I feel sorry for all the people that have seen my show normally and see how unprofessional this is for me today. Don't forget the reservoir on upstream. Without it, there is nothing. Yes. So we have to have the reservoir. So all of the hydrocarbons in the ground. There's our reservoir. So luckily we have industry experts like John DeWart here to be able to keep me straight. And I appreciate that. Everybody, this is something completely new for me educating everybody on something that is probably not my number one strong suit. It's MWD, if anybody knows what that one is. All right, so the mirror inverted, you good. Oh, awesome. It's correct. It looks good. I just now saw it. That's good. Oof. Okay, like I said, so downstream is going to be the point in time where we're taking the hydrocarbons and everything that came out of the ground, that was put into a truck or put into the pipeline, and then they're going to turn it into gasoline, byproducts, asphalt. There's about 1 billion different things that this goes into. Your glasses, your shirts, materials, all of that. Tons and tons of byproducts that are used from what is created on the downstream side. So, like I said, this is Oil and Gas Investing 101. So the area that we're going to be talking about, right? Erase this. Tracy, tell me how that looks on the screen there. Does it look pretty good? Oh, it does. The erase is nice. We've had that as an issue before. So there's so many levels of success that are taking place right now. Little bitty wins for me right now. And I'm really excited about it. I should actually see. Should I up the light? Oh, it was good there. Okay. All right. So upstream is the sector that we're going to be talking about. And did you pull the...
It says it's already in use. It won't let me open.
Really? Okay. Well, maybe if I close it on this side. There we go. All right. Okay. So Tracy's going to work on that. So like I said, it did have just this real simple PowerPoint for it, just to be able to kind of go along and to be able to keep me on track. All right. So now we're going to talk about the life cycle of an oil and gas project. So at the very beginning of all of this, or what we can look at, and this is from very basic standpoint, because I don't want this to take too long, right? So we've got exploration, and I think I missed an L in there, but whatever, you guys. Right, exploration, drilling, production, and you might have said drilling / completions in there. Right, I actually had this. Dang, that was one of the ones I definitely did have the notes on. And then at the very end of this, you might be able to say rework and then decommissioning. And don't spot me on any of my spelling or anything. We're just trying to get the ideas across, right? So exploration. So this is at the very beginning of being able to look for the oil and gas. So let's say we've got this big landmass here. So exploration is going to be talking about we're going out and we are trying to be able to find where the oil and gas is at. There's many different ways to be able to do this. We're not going to get into the super technical side of this right now, but what's going to happen is there's going to be a geological team, petrophysicist, or just crazy risk-taking individuals that lick their finger and stick it up in there and say, hey, let's go drill over there, right? And so they're going to find an area in particular, that area of interest, right? And we'll say it's, this area right here. And so once they have denoted a spot to be able to go and drill, that's what they're going to do, is they're going to be able to lease the area, right? And we'll get into that step here in just a sec. They're going to lease the area. They're going to go out there. They're going to put a wellhead out on location, or they're going to put a pilot hole, and they're going to drill that hole in the ground. So you're going to go through your drilling. That is the act of being able to put the hole in the ground. This is very loud. I need to put that down. Hold on. Okay. I don't know why, but I'm getting lots of voicemails here, right? So, oh, that's the guy from next door at the gym. Would you call him, please? Just let him know. Sorry, I'm in the process of opening another business and the neighbor's calling. Right. So back to this. So we're going to find a spot to be able to drill. We're going to drill a hole in the ground. That is the process of being able to go from just flat earth to being able to put some form of hole in the ground. That is your drilling spot. Once that's been done, then we need to be able to complete the well. That's the act of being able to facilitate getting the hydrocarbons out of the ground and up out of the hole. right? So that's you got drilling, then you've got your completions, right? Now, once the hydrocarbons are coming out of the hole, then we're going to move on to production. And that's going to be the act of so many technical things in here, but just for lack of better words, it's all about being able to get the hydrocarbons out of the ground and continue to keep them flowing to the midstream. Yeah, don't say that too loud. I don't need everybody knowing the passcode of my phone, right? Like I said, production is going to be getting all of the hydrocarbons out of the ground and continue flowing to our midstream. Now, I say rework here because we're just a quick little lifespan of the well. Rework could be after the well is not producing as well as it once was, and we can go back to the hole and either deepen it, go a little bit further down, or drill off to the side, make a hole off this direction, or what we also call in the industry, we could just go in here and say that there's a little scale that's been built up here, and this is where the formation was at. We can go back in here, we can clean this out through multiple different operations, won't get into that, and just kind of what is like the word sounds, rework the well to be able to get the flow of hydrocarbons going again, right? And at the very end of the lifespan of a well, after it has no longer or is no longer economical to be able to continue production, right? Then what we will do is decommissioning. And I definitely spelled that one wrong. So we'll do decommissioning, and decommissioning is in the industry we'll refer to plug and abandonment. And so that is essentially there's a hole in the ground. And we don't want there to be just a random hole in the ground. So we fill it with cement, right? We'll fill it with cement, right? And so now the well has been plugged and abandoned, hence plug and abandon, or as we also call it, P&A, right? And that's at the very end of the lifespan of the well. And if everything's done properly, according to, oh, wow, 9 members signed up. If everything's done according to government statutes, everything's been done, that's been taken care of. So that's a quick run, like the absolute quickest we could go through it to be able to say those are the steps that we're going to take in the lifespan of the well. All right. So do you have that? Oh, I don't know where Tracy went. Okay. All right. Good evening, Gibson. Greetings from Bogota, Colombia. All right. Glad to see you here. All right. Right, guys. So you guys do have any more questions or anything like that as we go through this, please be sure to throw them out. I know I've got a lot of people in oil and gas that are watching this, and that they probably are not too worried, or this isn't this is all basic stuff for them, so they're probably not going to be the ones asking questions. But if you do have a question, please feel free to be able to ask. All right, so with oil and gas wells, what do these oil and gas wells produce? We're going to produce 3 things out of the ground. So we're going to produce oil, we're going to produce gas, and we're going to produce water, right? And I bring this up because 2 of these we make money from, and then the other one cost us money. We'll say, I don't want to get too technical, but there are some times I actually think that there's pretty good water. So now the water that's coming out of the ground, don't think of this as the water that's coming out of your faucet as well, or what you put in your pool or anything. This is water from very, very deep in the ground. It's way, 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 way below the freshwater aquifer. That's actually regulation that you have to drill past that, cement and everything. And so that's not the kind of water. This is going to be water that's coming out of the ground simultaneously with the oil and gas. And this portion of it, we have to dispose of or do something with. Most of the time, this just gets put right back in the ground, either at the same location or at an offset location in a similar interval to where this came out of. Really kind of area dependent as to what takes place. But trust me, it just doesn't get dumped into a lake or anything like that. That's definitely not what happens there. So oil and gas wells are they're gonna have those 3 things are gonna be the 3 things that are produced. So let's talk about, well, if 2 of those produce money, right? Who does the money go to when the well makes money? So, all right, so you've got, let's draw a nice little bar graph here, right? Ooh, that made a really cool noise. Right, so you're going to have essentially two parts, and I'm drawing this somewhat to perspective. So you're going to have your working interest partners. All right, I'll write that out. Working interest, right? And they're going to have a percentage of the well. And on the other side, you're going to have your royalties. And they're going to have a percentage, right? So we'll go back and we'll draw our little area again. So like, let's say that, we've got this, random area once again. So in the process of being able to do this, somebody owns this chunk of land right over here. And we have what we call a landman, right? And this person, their job is to be able to go find who owns this piece of land, right? Now, I don't want to get too deep in it, but yes, somebody can own the land and the mineral rights, and they can be separate, and that creates a whole nother 10-minute conversation. But for this, when we say land, we're just going to assume that the landowner and the mineral rights owner are the exact same person, right? So this guy's responsibility, or this lady's responsibility, is to be able to go visit with this person and be able to attain the rights to be able to drill on their land. Right now, this person, if they have it, the gumption, they could drill on their own land, and 100% of this could be all theirs. That's completely possible. But most of the time, people like myself, even or Tracy or anybody else that I've ever met, really doesn't know how to be able to A to Z drill their own wells on their own land. Just kind of a rare instance, but it does happen. So let's talk about the 99% of the time. So like I said, this person who owns all of this is now going to create a lease, right? And in that lease, what they're going to say is that they want to get a percentage of royalties of anything that the well produces. And the majority of the time, this comes out to somewhere around, let's say, 25% is what they're going to get, right? And that's or I should say that, let's actually back that up. Let's say that they get 20%, right? They're going to get 20%. But most deals that we will see, the royalties are going to have 25%. Why is that? So on this 20%, how did it get to 25%? Possibly that person right there. They may not work for the company that created the deal. They could be separate. And so what they could do is carve out a portion for themselves. And so that's why it's called royalties and not mineral rights. So this person has the mineral rights here. So anything that takes place on that land, they're always going to be able to get a portion of it. Every deal could be different. Multiple zones could be different, right? So if this is our land right here, somebody's little house here, they could lease out just this portion, right, from here to here. Or they could lease out just a particular zone, right? And so if they lease out just this zone to one company, to company A, let's say they get the rights to this, and they've got a 20% deal here, and then on this one, it's for company B, and they've got a 22% deal here. This is all possible, right? But at the end of the day, most of the time, the royalties on a oil and gas deal are going to be at 25%, right? And so that's just pretty basic, straightforward. I'm going to move some of this off the screen here so that I can go back, right? Make sure we haven't been getting any questions. Good evening from Hernan. Well, thanks for being here, sir. I do appreciate it. And I will say that the vast majority of this is going to be conducive to oil and gas deals within the U.S. And specifically, let's just focus it down to Texas. I don't want to get into all the rules and regulations everywhere else. right? So like we said, so right now we're talking about where does the money go from the well that's being produced. So if this well makes $100, under the current circumstance, right now, the royalty owners are going to get $25, and they get paid directly off the top. So any money that's made, it goes to them first before anything else happens. So like I said, so if this makes $100, then right off the top, $25 goes to our royalties people. Whoops, royal. Right? Such amazing handwriting. See, Tracy, you need to be so good at this so you could teach the class and write all of this. All right. So now we're down to $75 that's left. Now that $75 goes to the working interest side. Right? And I'm going to say side because I'm not going to say partners yet. So that's where the money's going to be. And we're going to dive real deep into this one here in a second. But I just want to be able to break it down. So where does the money go? Portion of this is going to go to our royalty owners, right? Whoever that side is made up of. The largest portion of it's going to be the mineral rights owners in whatever percentage that they have. And then whatever's left over is going to go to our working interest partners over here. I shouldn't say it goes all to all of them, but it's going to go to this side, right? So we can go ahead and dive into this a little bit, kind of getting off order because I messed myself up not having this PowerPoint presentation ready to go. But that's okay. That's okay. Just like everything else in life. You screw up sometimes and you just go with it, right? All right. So since we're talking about it, let's just go ahead and dive into our working interest partners, right? So like I said, if the well makes $100, right? And that's, let's say, total revenue. And then $25 goes to the royalties, right? So now we are left with $75 left. All right. So the $75 that's left goes to our working interest side of the business. So what does it mean to be on the working interest side, right? Well, that means you're on the business side. So just like in any other business, you've got overhead and / aka bills. Got to pay my bills, right? So you've got bills that need to be paid. And so all of the bills that are acquired or that come up from operating the well on a month-to-month basis and or even getting the project started, that is burdened onto our working interest side. So like I said, for a quick example here, let's say that on this one, the electricity to be able to keep our little pump jet going. Can we see that? Is that on the screen? Okay, cool. To be able to keep our pump jet going costs $5. And then there's a $5 tax. So we're up to $10 now. And then as my great friend Rick Allen says, rope, soap, and dope is another $15, right? So we're up to $25 in bills for the month, right? So now the profit that's left over from that is $50. And so that $50 will be what goes to the working interest partners. I'm just going to put working interest, right? And so that working interest percent is that $50. And that $50 goes to whomever is on the working interest side. Let's say that there's 5 people and they all have equal shares in the working interest. The working interest is a total 100%. And that total 100%, each one of them has 20%. So each one of them is going to get $10 at the end of the month. That's how that's going to work out. So with that, you can now see how the money kind of breaks down as it goes down. And since the working interest side is the one that bears the burden of paying all of the bills, this is what we need to be able to see is what is taking place. Is it economical? Is it worthy being able to put money in to be able to have the cash flow afterwards, right? So we'll kind of, I don't know how deep we're going to be able to get into all of those little nuances, but like I said, this is just to be able to kind of break some of this down and be able to look at it. So I want to take a step back and be able to look at, let's think about the different types of wells that are out there and what we could potentially be investing in, right? Because that's what we're looking to be able to do, is invest in some of these wells. And now, when we talk about investing in them, you can invest in mineral rights. You can go out there and buy people's mineral rights, right? It's definitely a possibility, but it's a little bit, that's going to be, dang, how do I say this? That's going to be a little bit more difficult than what we can cover all in today's. So, like I said, let's go back and look at some of the wells, right? So, once again, we had this big field here, right? And let's say we've got an area here that's already been drilled. So we've got a bunch of wells here. Love making all the little dots. And then there's a couple out here, and then one here, and then this whole area will be blank, right? So when we look at this, any of the wells that are drilled significantly away from any other well, let's say it's drilled right here, right? I'm going to call that a wildcat well, meow, right? So that's what we're going to be looking at, is a wildcat well. So I'm going to write that up, wild. With a wildcat well, it's not, there's nothing really out there to be able to look at that says that yes, there is going to be oil and gas here based off of other wells that have been drilled. Now, you might have some science that goes into it. Like I said, we're not going to try to get too deep on this, but there could be things like 3D seismic, geological history. There's going to be tons of stuff there that says that, hey, that's a really good spot to be able to go drill at. But if it's still the very first one in an area, and an area could be somewhat of a, I don't know, vague point of reference, just because some areas, some people call it wildcat, some people will say, oh no, it's a step out. It's still close enough. We're just going to say it's not here. Anything else, we don't really have any other history to go off of. That one's way out there. So we have really no idea what we're getting ourselves into. And so this kind of well is going to have the highest level of risk. Right? Highest level of risk. All right. So then the next step down from that, right, would be a well that's like, let's say we've drilled the well here. Now we're going to, we determined that there was something there, right? Well, now we could step out a little bit further and see how much further the well goes. And so with that, we can call it, a field play or a step out well. Right? So we've got an idea because of this well that there is something there, right? And now we're going to drill another one in a similar distance to it, right? That's going to give us, there's going to be some level of reference that we can build off there to be able to go for this. Now, when we start looking at this, we have to start thinking, all right, is the formation that we're going to be drilling into, is it what we would call a stratigraphic play, or is this a field or basin level play, right? Right. And so what I mean by that, and a lot of people have probably heard of the Permian Basin, right? That is an entire area, right? That has I would say a consistent formation, right? So Earth, round, right? So here's a drill area just for reference, or we can draw somebody's little house right here. Doo -doo. Right? So you're gonna have all these different layers and formations down here, right? So how consistent these layers and formation are from one point over to the next can be vastly different, right? Just like you've got the Rockies and then you've got beaches, right? Hills and mountains and valleys and all that. Same kind of thing is happening below our surface, right? But in large areas, you can still have consistency in these formations for hundreds of miles. Now, the depths at which they occur might be different, but the fact that they are there is consistent, right? And so that's where we get into something that is like a like I said, a basin, right? So that's completely opposite of a wildcat well, is looking at that. The reason I say this is because if we're looking at something like this, it might be one of these wells where there's a little formation and then that's all there is. So if you drill the well, oh, you missed it. But then you pop in, put another rig over here, and then you drill, let's say it just gets a little crooked, which happens from time to time. And then this one hits it, right? That's going to be more of a field level play or a step out well, or could even be considered to be a stratigraphic play to where the formation that we're looking for literally only exists in that little area. So if you're drilling in these areas, you'll hit it. If you drill over here or over here, wrong answer, right? We'll say wrong. Brooklyn's gonna love the pink. Oh, you can't even tell if it's pink, can you? Everything just looks kind of blue. Somewhat. All right. So like I said, if with the stratigraphic play, right? Field play, step out, and then pretend a stratigraphic play there, right? That's what's going to happen in some of these small little spots, right? You're trying to hit just a specific little area of a formation. And now this can be relative as far as size, but it's not going to be the size of a county, right? It's not going to be the entire size of a city. It's going to be a fairly small field or play where this is drilled at. All right. It's important to be able to note that, right? So what's the next on the list there? So field plays, graphics, and then basin plays, right? So think of like this entire area being a basin that has a consistent formation on it. Then drilling wells like this all the way across it would pretty much be par for the course because you're going to be able to harvest as many hydrocarbons as possible. So now I say all of this because a lot of the questions that we get or that I've received about this is people saying, well, what's my ROI going to be? I'm not going to get into the ROI just yet, but you have to take this into consideration as far as the risk factor. If we know that the formation exists across an entire county, well, then the chance of missing it, like we did here with this well, right? The chance of missing this is very unlikely. Now, could one well to the next well have different production values? Yes, but the chance that you're going to completely miss it and not be in the right spot, it's going to be astronomical that you're going to be in the perfect spot that has nothing there, right? Can it happen? Yes. Oil and gas is risky, right? Let's make sure we get that across, if anything, today, right? So with this, if the chance of missing this is very unlikely, the formation's going to be there. Now, with something like this, where we're at a much higher risk, we're wildcatting, we're drilling wells that have never been drilled before, right? The chance of missing it is high, right? And that's where we need to be able to use different science, different techniques, experience to be able to make sure that it's there. And so I get into saying this about ROI because if you've drilled a ton of these wells right offset to one another, then you've got a good idea as to what they're going to produce when you come over here to drill the next one in this kind of scenario, right? So when you come over here and drill this one, then, oh, this thing's about to drip everywhere. Sorry. All right. So once you get over here to be able to drill this one, you've got a good idea. You've drilled tons of these. So if somebody says, oh, well, you know, what's going to be the payout and what's it going to be? If you were drilling in this kind of situation, then yeah, you could probably put pen to paper and be able to say what it is. In instances like this, you've got no idea. And anybody that says that they know exactly what that well is going to produce at when no other wells have been drilled around it, or there's no existing production in the area, I would say that's probably the riskiest thing of all, and you should just run for the hills, right? Just get out of there. Just go, right? Not to be trusted, not to be taken serious. The technology in the oil and gas industry is not there yet. The only way to be able to find out what the production is going to be is to drill the hole, complete it, and bring it online. At that point in time, then you can be able to say, oh, well, look, it's done this for so long, it could probably produce for X amount of years, right? So this is what we want to be able to say. So wildcat wells are our riskiest of wells. And then our field level plays are our basin plays, right? So field or basin level, from a drilling perspective, are going to be some of the lowest risk when it comes to drilling of wells, right? So let's talk about, well, what if the well's already been drilled, right? I need to be able to work quick on this, trying to be able to go through this quick. I completely butchered my entire agenda and outline that I was going to do, but we're covering a lot of stuff, and Tracy's taking good notes, and we'll just make sure we make this even better for the next time. Actually, if anything, we should probably break this down into like 20 little videos. And we'll get Rick from next door to be able to help me out with them. And then we'll just upload them as we go. Right? So you've got drilling projects, right? Well, what if the well's already been drilled? Well, the next step of that would be called a DUC. We won't get into that, but that's drilled uncompleted, right? So that is a prospect. But let's say it's been drilled, it's been completed, right? And now it's producing. So let's say producing. Well, at that point in time, the well's in a completely different framework as far as risk is concerned, because it's already putting out money, right? So at that point in time, you're not, the risk factor it's all but gone. I don't want to say it's completely gone, right? But you're not purchasing, if you're getting into doing the investing, the risk of losing all your money is not really there, because if it's producing, let's say it's producing $100 a month, well, then you can pretty much say, okay, well, if it's producing $100 a month, I will give you $2,400, and that's 24 months worth of revenue for that. And when I say producing $100, it's the person netting, getting checks for $100, right? So if they're getting those checks, and so for $2,400, it's like, hey, I'll take that off your hands, and you get your money now, and then in 2 years, 1 month, hopefully it's still producing that same amount. It won't be. And then you're in the profit zone, right? So when we talk about this, drilling being the highest risk, producing being significantly lower risk, right? And I wanted to be able to kind of make this distinction so that people can understand what they're kind of getting themselves into. Because if you're looking for a drilling prospect and then you ask them, hey, what's my ROI going to be? It's question marks. That's all it is. Now, if you're going to buy a producing asset, then yes, then the ability to be able to figure an ROI is going to be substantially easier. It's not going to be exact, right? But then again, no business is exact. Even if you go and buy a laundromat or a self-storage facility, right? There's still going to be ebbs and flows. Things can still happen. But within oil and gas, right, there's not an infinite amount of hydrocarbons that are below the surface. So the number's not always going to stay the same here. It's going to follow what we call a decline curve. We can draw that real quick, right? It's going to be like this, right? And at some point down here, I didn't really draw that straight enough. Let me try that again. At some point in time, right, as this is going down, it's going to reach what's called its economic limit, right? We'll say that right there, right? It's got to stay above that, right, to be able to be worthwhile, right? Because it takes money to be able to keep these little pump jack going, right? Got to have electricity, right? So at some point in time, it's not going to be there. So if this thing's producing $100 a month at this point in time, and then let's say that this is your 2 years later, right? Now it's, I don't know, let's say this is $25. That's 100, right? If you know this, then you can do your little projections. Then you know how much money to be able to offer them, right? So once again, going back to this. So we're doing the drilling. This is going to be the highest risk. You're going to have a lot of unknown here. Not until you have drilled the well, completed the well, and it is producing, will you be able to make this nice little chart here to be able to understand how much it's going to, or what your ROI potential is. So you're not going to know what your ROI is before drilling the well. Like I said, unless you've got 100 little wells that you've drilled offset to it, then you can probably be able to figure that out. But until that's happened, you're not going to know. All right, let me take a quick pause right there. I'm gonna look to see if we have any questions so far. Tracy, have we got any brain busters in there? And if you guys have got questions, like I said, feel free to be able to ask them. All right, good evening. Is Kohi writing backwards asking for a friend? No, just it's little visualization that switch it. Drilled usually in state-owned school sections. Okay, sounds good to me. Jody Newbergstrom, I think he has an app to invert it the right way. That is correct. I do have an app to be able to invert it the right way. All right. All right. So we've talked about the different types of wells. Oh, one of the ones I forgot to be able to put in there. So we've got to be drilled, producing, and now we're talking about deals, types of deals. So you've got wells, drilled well, or wells to be drilled, wells that are already producing, and then your potential for rework wells. So these are wells that are producing but not doing as well as they should be, or wells that have stopped producing and they're old wells and that people want to be able to go back in and do what the word says, rework them, get them flowing again. How are we doing on time? Good gosh, it's already been 48 minutes. Wow. That really threw me for a loop. So drilled, producing, rework, right? So we've got that in there. All right. Wow. I am not getting through this as quick as I would have said. ChatGPT has led me astray in being able to say, hey, here's 10 minutes for this section, 10 minutes for this one. That, and I didn't stay consistent with my format that I was doing. So, like I said, hey, anybody that is out there watching, guys, please let me know. Give me a little shout out in the comment section there. Like I said, we'll try to keep going through this pretty quick. All right. So, next up, let's talk about the official roles of working interest. So, one of the things that with deals that get put together, and a lot of the questions that people ask is, what is the responsibility of the working interest? So like we had up here before, right? We had this split. There was I'm just gonna leave it as royalties, and then WI for our working interest, right? So our working interest partners are going to be the ones that are paying for everything that takes place out at the well site. So this is the business end of the deal. So for example, once the well has been drilled and the well, let's say the motor goes out in the pump jack, right? then in that instance, the working interest group will be responsible for paying for that motor to be replaced at the wellhead. Now, let's say that the well's making, let's go back to our example before. So it makes $100 a month, $25 goes over here, $75 is left, and the motor goes bad. Well, the motor costs, $25. Well, we had all of the other stuff in there, like we said before, $5 here, $10 there. We had $50 that was left over. So there's another $25 gets taken out. So we've got $50 in bills for that month. Now, right? Now our split is going to be $25 to all of the working interest partners. Right? Instead of 50, now it's 25. And if we had 5 partners that each had 20% in there, so instead of getting $10 previously, right, because that motor went bad, now it's down to $25. Now, what we were talking about just a second ago is the where we did the rework. Now, let's say that on this well, it's not the motor that goes bad. It's just the well stops producing. It's not doing so well. And the decision is made and says, you know what, let's go back in and let's rework this well. Okay. Well, that might exceed $25, might exceed what the well makes in a 6-month time period. So at that point in time, anybody that's involved in the working interest side, it's going to be their responsibility to be able to come up with the money. So that comes into our next thing. It's called cash calls, right? Cash calls. So on a cash call, all of the partners that are involved in the working interest side are going to be said to be hit with a cash call. And they're going to say, hey, look, we're going to go back and rework the well. And let's say, the cost is $10,000, or let's make it easy because we had 5 partners. Each of them had 10 or 20% or whatever, right? Let's say it's cost $5,000. So then each partner is going to get hit with a $1,000 bill, right? They're going to say, hey, look, this is what it's going to take to be able to rework the well. And all of the partners that are on the working interest side have got to put up the $1,000 to be able to stay in the program. If you opt out, so it's what we would call non-consent. If you opt out, then you are no longer, I would just say, let's just go with it. You're no longer going to be able to have your stake in the well. Now, non-consent can, depending upon the contract that you sign, can take place over, there's millions of different ways that these contracts can be handled. But let's just say that you decide not to. Well, you could pretty much take that anything that happens with the well after that. So if they do this cash call, you say, you know what, this is getting too expensive for me. You get out of it, and then the well comes back on and it's producing $15,000 a month. Well, too bad, so sad. You're out of the game. The people who put up the money, there were 4 partners left. They took it on. They each put in their $1,250 for the new to work over the well. They're going to be the ones that are making all the money now. And you're, like you said, you went on consent. You said, I want out. I'm not doing it anymore. There you go. So the big thing to be able to remember here for somebody in this example is on the working interest side, you are going to be responsible for the cost of the well. If those costs of the well exceed what it makes in a month, then there's going to be the potential for the cash call that I just erased, which now I'm thinking I probably shouldn't have done. You're going to get hit with what's called a cash call. And so then the cash call, right, will go to be able to pay for everything, right? Royalty owners are not paying this at all, right? They're just getting money straight off the top, okay? All right. So like I said, you're going to get hit with a cash call. If you don't go with it, then your interest in the well gets ported over to others, whomever the contracts are going to say that. It's a million different types of ways to be able to write it. Somebody else is going to end up with that percent and be able to get that money, right? So one of the big things there. Now, a lot of people will say, well, what's my risk and the obligation that I have being in the working interest side, right? And this is kind of getting me finally back to where I was wanting to be at. All right, so on the working interest side, you've got 2 different types of partners in there. You've got the non-op. Ooh, what's that mean? And then the operator. So, man, I've got beautiful handwriting. Got to run, David. Have a lecture to give. Great overview for prospect to investing. You're explaining it really well. Oh, thanks, Mom. Look at that. My mom believes in me. Wait, show it. You're explaining it really well. Oh, thanks, Mom. All right. So on working interest side, we've got non-op and the operator. The operator is going to be the person that is responsible for the oil and gas well itself, right? They're going to be the person on a day-to-day basis looking after the well, turning wrenches, paying people to go out there and look at it, calling to make sure that the oil and or gas gets hauled away, right? The non-op, be somebody like myself, you're just paying for everything and collecting checks. That's it. You don't have any responsibilities at the wellhead. So in the contractual agreements, most often they are a joint operating agreement. So joint operating JOA, right? So in the joint operating agreement, it will state something along the lines that you're indemnified with the operator so that if anything goes wrong, you are completely taken out. Nobody can come back to you if somebody gets hurt at the rig site, or if there is a leak of some sort, something tragic happens, they're not coming back to get you. Everything goes to the operator. So it's an important distinction. I've gotten this question a lot, just because people want to be able to understand their liabilities and stuff. So take this out of your risk factors. Plenty of other risks. This is not one of them, or should not be one of them, depending on how the JOA was written. If it says that you are responsible, do not sign that document. Don't do it. I'm not a lawyer. I'm not a CPA. I don't give legal advice, but don't do it. Definitely don't do that. Right. So now the operator and the non-op both are going to get paid the same. They're not going to be separated on the royalty side. So, if these guys have 10% in the well, right, and then these guys have 90%, right, it's not, their 10% isn't a royalty coming off the top. They are also paying the bills and everything else that goes along with it, right? So there we go. Just important little things to be able to think about there with the working interest side. Okay, how are we doing? Oh, Carlos is calling me. Gotta run, David. Carlos is from the phone. Did you answer that phone? Oh, you're calling? Okay. All right. Sorry. So we're already an hour in. I am completely not following wow, there's a ton of little dry erase things all over my papers here. All right. What else did we cover that we need to cover that we haven't covered? Depth, in-depth, X% in the lease, promote, carry to interest. Okay. So one of the things since we just had it up there, once again, I erased it too soon, right? In working interest deals, which is the area that I'm mainly focused in, that's the point of this one, right? So you've got the operator, and then you've got the non-op partners, right? So most of the time, just left her off there. Most of the time, your operator is also the one who put the deal together, right? Everything okay?
Yes.
Okay. Most of the time, the operator is the one who puts the deal together, and they're going to get what's called a carry, right? And then you're, in terms, going to pay a promote for that carry, right? So what does it mean for them to be carried, and what does it mean for you to pay a promote? So anytime you see carry, right, carried interest, or even like override interest, right, essentially equate that out to, I shouldn't say override, let's just say carry. Anytime you see somebody talk about the carry, that equals sweat equity in the deal, right? And if there's sweat equity in the deal for either the operator, the geologist, or anybody else on the deal, that means anybody who's not the operator, the geologist, or whomever, the non-op participants have to pay a promote price for that. So what does that mean? So let's say on the working interest side of the deal, right? Because we've already carved out our little spot for the royalty owners, right? So royal. So we already carved them out. On the working interest side, this is 100%, right? 100% of the working interest, right? 100% of the working interest. Well, somebody on the working interest side had to come up with the idea on where to drill, right? We had this map over here, and they're like, I want to drill right here. That's the spot, right? They did all the homework. They went and found the land. They did everything that needed to be done to be able to say, that's where we're going to go drill, right? That person is going to say, hey, look, I put all of the work together. All you're bringing in is the money. If you're just doing that, then I want 25% for me. And the rest are going to have to pay the full 100%. So this is what's commonly referred to in the industry as a third for a quarter, right? So you're paying a third of the cost. If the cost of this well, right, it's $100,000, the partners, and let's say there's 4 total partners, right? Well, the carried partner puts in 0, so we'll call him partner A. Partner A puts in $0, right? Partner B is going to have to put in 33. What do we say? So 33,000. Partner C, 33,000, and then partner D has to put in 33,000. And this is usually just for the drilling deal. So partner A puts in nothing. He's getting all sweat equity. B, C, and D are putting in 33,000. But at the end of the day, they are each getting 25% of the deal. And I don't need to write this 3 times, but I'm going to. Actually, probably have to write it 4 times because this guy's also getting 25%. You get 25%. You get 25%, right? So each one of them gets 25%. So the part that B, C, and D are paying, and essentially, if this was split evenly, right, that would have just been $25,000. So the promote price that these guys are paying is $8,000 to be a part of this program, right? Because you have to carry this individual here. So last week we were at NAPE, and I stopped by a booth. NAPE is will you find out what I can't even remember what I think it's North American Petroleum something or other. Instagram has disconnected the stream. They currently disconnect streams after 1 hour for most users. If you want to continue streaming on Instagram, you can remove the destination from the stream and re-add it. Not worried about it. Don't think anybody else is watching there. Cancel. Close that. Back to the show. Oh, I was right across my face that whole time. Okay. I do not use enough of this side of the board. Right. So I was at NAPE last week. What is it?
North American Prospect Expo.
North American Prospect Expo. There we go. Right. I was at that event last week, and one of the booths, the individual said that they were putting a deal together, and the carry percent, what does that say? I've got it written down right here. The carry percent was 35.71%. Right? So it'll be even further down here, right? On this thing. So their carry was 35.71%. And the deal, how much was the deal was the cost of the deal was $12.4 million, right? So what that means is that if you wanted 1% in that deal, it was going to cost you $192,000 for 1%. right? For 1% in the deal is going to cost $192,000. And for that 1% that you paid, the promote price of that was $68,000. That is a massive red flag. Third for a quarter is like a high, like this is we'll say typical retail. Typical, I can't write. Why do I want to do writing live streaming? That's just dumb, right? Typical. There we go. Third for a quarter is a typical, like if you see this is think third for a quarter, think retail investor. That's what you're getting. You're not wholesale, you're not in the industry. If you're in the industry, you're not raising money, you're doing it yourself, right? But if you're outside of the industry and you're looking to be able to come in and somebody else has put in all the sweat equity and put in all the work to be able to find a spot, and then they're just going out and raising money from lawyers, dentists, and goofballs like me, then you're going to pay a third for a quarter. And that's okay. But this nonsense, nobody should be paying that. When I see a deal like this, these guys aren't looking to find oil. They're looking to find a paycheck, because all of that money right there is going to them. Whoever put the deal together, or whoever the operator is, whoever put the deal together, they're pocketing that money, right? Or that money is going to be able to take care of their percentage in paying for this thing. And so it's one of those things where their carry percent should max out at 25. If it starts to go over that, then I don't know. I don't think that's very good. Now, having said that, now there was another deal that I saw while I was there, and this one I really like, and I'm really looking forward to actually investing in this one. Right? So the project cost was $1.5 million. Right? The carry on this one was 20%, right? So it's lower than our third for a quarter, right? And so since it was 1 point, so then our 1%, the 1% in the well is 18,750, and this is for a horizontal project too. So they're 1.5 million. They've got a really, really good AFE on this one, almost too good, but it's a shallow well, and it's a short lateral, so it's possible. But yeah, so 1% was 18,750 off of the 1.5 million, and so that means my promote price is only $3,750. That's pretty good. That's pretty good. So, like, if I was to go out and drill this project by myself and I was going to do it, it would only be paying $15,000. So, I mean, just under $4,000 for the promote price. Not too bad for the guys who figured it out, found it, and are putting all of it together. All right. Let's go ahead and erase that one. All right. So what else have we got here? Initial cost, capital requirements, concept cash calls, did that. Potential ROI. We kind of already talked about ROI. Understanding ongoing lease costs and operational expenses. Next, tax implications. Okay, we'll talk about tax. Tax implications. I am not a CPA. I'm not a lawyer. Anything I say and do, don't hold me into a court of law or anything like that, right? So we talked about a lot of these expenses and stuff, and that wells cost $1.5 million to be able to drill. Where does that money go? Well, it's going to go into two things: drilling and completions, right? So if the drilling and completions AFE, both combined, AFE, approval for expenditure, I don't know, I've heard other people say it different ways. So approval for expenditure, I'll go back to blue. If it's 1.5 million, right, then on our taxes, right, this gets broken down into two sections. It gets tangible and intangible. And just so I don't screw this up, I'm going to make sure I read from my notes here, which are sitting over there. Oh, they're sitting over there, Tracy. What's that other one I printed off? Oh, yep, there it is. All right. So on this one, intangible drilling costs. These are the costs associated with drilling a well that don't have salvageable value, right? Intangible, right? Labor, chemicals, grease. A significant portion of your investment in a drilling project is usually in the form of IDCs, intangible drilling costs. And these costs are 100%, 100%. I did that backwards. 100% deductible in the first year, right? Tangible drilling costs, on the other hand, are the costs of actual physical equipment and used in drilling, right? Rig, rig, drill bits, drill pipe, mud, these kinds of things. Those, right, are your tangible drilling costs, and those can be depreciated. So this one goes up here. Those can be depreciated over a 7-year time span, right? The final tax thing is called a depletion allowance. This allows the owner of an oil and gas interest to account for the reduction of a product's reserves. Two types of depletion allowances are cost depletion and percentage depletion can be applied, but percentage depletion, allowing you to deduct a fixed percentage of the gross income, is more common and can be a significant tax advantage. Once again, I'm not a CPA. Do not trust me on this one. Now, the reason I want to bring up the tax stuff is a lot of times in investing in oil and gas wells, you'll hear people saying, tax benefits, tax benefits, tax benefits. If the number one thing that they do to sell an oil and gas lease or to get you into leasing an oil and gas property is based off of taxes, then you should run. Plain and simple. The reason that we drill oil and gas wells is to drill into the reservoir and to find oil and gas, not to have tax benefits. Tax benefits become a secondary and tertiary benefit of finding oil and gas. So anybody who keeps promoting, oh, you get tax benefits, you get tax benefits, you get tax benefits. You know, there's a lot of other things that you can do that are really good tax benefits. Open another business, donate money, right? If you're just going to give it to some random person to go drill a hole in the ground, then and you're doing that to get tax benefits, then you know what? Sign up with me and just give me all your money and I'll take care of it. And then I don't know, every once in a while, I'll send you a Christmas card, right? But really, if somebody's number one technique for selling an oil and gas project is tax benefits, just run. That is a huge red flag to me because they're not focused on finding oil and gas. They're just focused on finding your money so that they can keep, drilling miscellaneous holes in the ground and making money off of the project as opposed to off of the oil and gas returns. So just want to be able to say that. And that's all I'm going to say about taxes because I am not a CPA once again, and that's not my area forte. So what's your thoughts on back in after payout deals versus third for a quarter? Question there from Alex McDonald. Right. So Alex is asking about back in after payout. Okay. So what this means is a back in after payout. So I don't even know how to draw this. So we have their third for a quarter, right? Right. So 25% of this was knocked off there for our sweat equity partner. So in another instance where the partner, instead of saying, hey, you're going to cover their costs at 25%, what they're going to say is, on this side, they're going to be either whole or they're not going to get any upfront, but after time has passed and the well has made, let's say the well's made, let's add another, let's say the well's made $10 million. Yeah, I can just keep adding zeros, right? After the well's made $10 million or some figure, X amount of money, or X amount of time, then they get 25% of the well. And we're just using random numbers here, right? So after a certain amount of time. So I saw a deal the other day that said, after the well makes 400%, or you get a 400% return, right? So we can do that one on here. So if it was going to be a 400% return and the well cost you $1,000, right? So once you've made your $4,000 back, or would that be 5,000? Yeah, 400. Let's say you made whatever, you've made your 4 times back, right? Then at that point in time, the person that put the deal together then gets to take over X%. And so anything after that, that's what they get to do. So they want you to be successful and you to be able to get your percent, and then afterwards be able to back in. I am all for these deals. I don't see these very often. Where you do see these deals is when people are selling producing assets that are already producing and then possibly need to be reworked. And you need to step in and be able to pay a whole bunch of money to be able to get them going again. And once they're going again, right, and you've made your money back and you've made a certain amount of money, then they want to be able to get back in the ball game and have 1 to 2 to 3 or 4%. If that's the case, I think those deals are okay. I don't see anything wrong with them. Once again, it's a case-by-case scenario to be able to look at the well and look at how much it's producing, how much it's going to cost to be able to get it in there, and then be able to go for it. Now, I haven't seen any back-in after payout deals from the very beginning. Maybe I just haven't seen enough deals. Alex, if you've seen one, feel free to shoot it over to me. I'd love to be able to look at it, right? But I haven't seen any of those deals where it's upfront on the drilling side to where all of the investors get to have their portion first, and then whomever it is, gets to jump back into the game. Mainly because right there at the beginning, so like if we look at the decline curve, right there at the beginning, this portion, where the vast majority of what the well's going to produce, this is right here in the beginning, the first year, 2 years, right? This is when you want to be a part of it. If it's back in after payout, they could be getting in at, these different points here, and you have no idea how long this is going to go for, and the well still be economical. So getting in at the very beginning, I think is more advantageous, right? Alex, thanks for the question. I do appreciate it. That's a good one. Almost stumped me, or you did. I don't know. Oh, wow, that looks cool as it's being erased. Whoa. Okay, I feel like the weather person watching a different screen as I'm doing something. All right, you guys are going to have to give me y'all's thoughts here on the glow board. Is it just the whole side of it there is reflecting onto the screen. Okay. All right, so we covered the tax benefits. I am all over the place. I think that's about all the stuff that we were going to cover today. I know that I need to be able to go back and redo this and be able to cover this in shorter times intervals and be able to discuss the very specific things. But I said to myself, I wanted to be able to put this together no matter how bad it was, because it will never be this bad again. It can only get better. So I appreciate all those that stuck around watching for the entire time. I will let you go back and go live the rest of your life. But yeah, if you guys have any more questions or anything, please feel free to reach out to me. You guys can find me on LinkedIn, YouTube, X, Twitter. Really, it's just the best ones, LinkedIn. But LinkedIn and Facebook, if you guys have any questions, feel free to reach out to me on either one of those. Tracy, anything? Oh, we never even did the giveaway. But for those that are watching, I normally do this. Let's see. We got 16 entrants. So present, share screen. So I do this normally on my show. Let's see here. Let's charge this thing up real quick. I normally do this on my show and I give away little drill bits, and I forgot to tell everybody even do this, but we'll add this in there, share. But I'll give away a 3D printed drill bit for anybody out there who's watching or asked a question. I got a feeling my mom's got a pretty good chance at winning this. All right, so let's see. Instructor lights, glass light. I'll turn this off and you guys will get to see. Oh, you can just barely see it. It does glow in the dark. See if it'll charge it up a little bit more. Yeah. All right. So we'll add that to the screen, add to the page, come over here. Tracy's so smart. And winner of the day is Hernan Rodriguez. Thank you, sir. Tracy, if you'll write that one down, we'll reach out to you, Hernan. You just won yourself a 3D printed drill bit. Thank you for tuning in and watching. All right, guys. That's it from me. I do appreciate y'all watching the show and taking the time to be able to do this. Like I said, we're gonna do nothing but get better with this. Lots of information to be able to share. Love for people to be able to join into the oil and gas industry and be able to invest. If you guys have any questions for me, feel free to reach out. Like I said, that's it for me. Anything over there, Tracy?
Good.
All right. And then, yeah. And as I always say, know your industry. And for this one, know your opportunities.